Hello guys, my name is Moico, NIM 2003040. I'm from Accounting Yogyakarta, LPP Polytechnic. Now, I'll tell you about Claudio and his business. Happy enjoy guys! In this video, I'll give you an introduction to accounting by telling you a story. It is a story about Claudio and how he runs his business in Italy. Before we start, let's just get clear on what accounting is. Accounting makes it possible to systematically record, analyze, and report important financial information and communicate the financial health of a business to all interested parties. It's called the language of business, and it is the backbone of any company because every business needs reliable data to make informed decisions. But what does that really mean? Let's just take a moment to make this a bit more transparent and understand the basics of accounting. So, let me tell you about Claudio. Imagine we are in Italy, which is also one of my favorite places, a nice beach city, where a man called Claudio. He only sells one item, a beautiful plate made from colorful glass. In the morning, he leaves his home with 100 euros and goes to the manufacturers of the souvenir. Each place costs 1 euro. So, Claudio buys 100 pieces with his 100 euros. He makes to the beach and sells the plates to the tourists for 5 euros a piece. And by noon, he's sold out. He goes home happily and repeats the same process the next day. After a month, he wants to know how much the business made. What if he sold more than one item? Which one was more profitable? Would it make sense to expand his business, like rent a fixed tent at the beach? Without a way of recording the daily activities of his business, he's not going to be able to answer these questions. Accounting makes this possible. Not only will each financial transaction be recorded, but Claudio will also get detailed reports summarizing his financial performance. We call these reports financial statements. Let's start with Claudio's profitability. If you want to find out about the business profitability, you go to their income statement. This is one of the main financial statements. There you can find out how much sales a business had in a certain period, which cost, and what was the resulting profit or loss. There is another name you may hear for the income statement. Do you know what it is? P&L. Yup, for profit and loss. It is a very simple business model, and the P&L Claudio's business would look like this. He sold 100 plates for 5 euros each. That's what we call sales or revenue, which were 500 euros. The plates he sold, he didn't get for free, right? He incurred costs to buy them. Each plate cost him 1 euro. Therefore, in total, his costs were 100 euros. We call this the cost of goods, which we need to deduct from revenue. To keep it simple, we don't consider any other costs for now, like fees and taxes. If we add this up, we can see that Claudio made a profit or a new income of 400 euros. That's our simple income statement will look like. Next, we're going to take a quick look at the second main financial statement, the balance sheet. The balance sheet shows which assets the company owns, the liabilities it owes to others, and the equity that belongs to the owners. Assets are usually things of value, or resources the company owns and uses. For instance, land and buildings, office equipment, inventory, or cash, just to name a few. Liabilities are what you owe to others. For example, a bank loan, or what you owe it to your suppliers for goods, or to the IRS and taxes. The third component is equity. This is a bit more abstract. It's residual amount that would be left if the company sold all its assets and paid off all its liabilities. And paid off all its liabilities, in other words, it's the difference between total assets and total liabilities. This leftover money belongs to the owners of the company. In the balance sheet, the assets are one side, and equity and liabilities are on the other side. If you draw a line between the two and one on top, it looks like a T. This is what accountants use to visualize accounting transactions. It is very helpful too, and we are going to come back to these T accounts all the time. You can see the left side of the T, it's just all the time. You can see the left side of the T is just as big as the right side. That's because everything the company owns, so its assets was purchased either from debt, so somebody else's money, or its money, meaning equity. For money to go to one account, it has to come out of another. We can this a flow of economic benefit from a source to a destination. We already said the assets minus liabilities equals equity. If we rearrange this like this, we will get assets equals liabilities plus equity. But sides are always in balance, hence the name balance sheet. And this is the foundation for any accounting system. The accounting equation, the total amount of assets equals total liabilities plus equity. Both sides are in balance. With that in mind, let's see how to balance sheet 100K like for Claudio. A balance sheet is always created at a certain point in time, like at the end of the business year or at the end of the quarter. In our example, it's the end of Claudio's business day. Claudio started out with 100 euros in cash, which is also the money or equity he put into the business. The cash on the left side equals the equity on the right side. The balance sheet at this point isn't a balance. Then he spent the cash in the morning to buy the colorful plates. The plates are what we call his inventory. In the process, his cash and got reduced to zero, but in exchange, he received another asset, inventory. He didn't get richer or poorer by that, right? The total amount of assets is still 100. But of course, his equities too. After he sold the plates, 5 euros each, he ended up with 500 euros in his pocket. At the end of the day, his inventory is on because sold of the place to the tourists. At the end of the days, his inventory value therefore is zero. He doesn't have any more plates. If we look at Claudio's balance sheet at the end of the day, we can see that the total value of assets, the left is 500 euros. That's the count with. On the credit side, we only have 100 euros. The balance sheet is out of balance. As we know, this can be both sides always need to be in balance. So, what's wrong here? The missing component is the profit he made during the day. If you go back to the income statement, we see that Claudio's net income was 400 euros. This will be added to equity. Why? Because due to his successful business, he made the business world more valuable, which he started out the day it was worth only 100 euros, which was the money he put into the business when he walked out the door. When he came home, he had sold all his plates with a profit of 400 euros. So, his business is now worth more, which is reflected in higher equity. Net income is the link between the income statement and the balance sheet. So, when we add the profit of 400 euros, he achieved to equity. Also, the right side gets to a total of 500 euros. And the balance sheet balanced like it should. So, that's how it would look like for Claudio at the end of his successful day at the beach. I hope this video was helpful for you to get familiar with accounting basics. Thank you!